Okay, let's take a live look at what's happening with stocks at this hour. A positive start to the Friday session. The TSX with a 90-point climb to begin the day. That's about 0.5% higher. Not a lot of action for the Dow, but it's on track for a weekly gain. And even though you got all these worrisome headlines right now, we mentioned the S&P 500 popping through 4,200. And it's coming off a session where it closed at its highest level in 9 months. So let's get some perspective from David Nelson, Chief Strategist at Belpointe Asset Management. David, it's nice to see you. Thanks for your time on this Friday. Can you balance these stories for us? The fact that there seem to be a lot of worrisome headlines, and yet equity investors are staying in the game for now?
There's a few major themes out there, John. Obviously, the big headache right now and the big fear is the debt ceiling, but at least both sides seem to be negotiating. There is one wrinkle there. Even if we get a deal before the ex-date, that could actually trigger something of a run on stocks. You know, Treasury right now, they've been running down their general account, probably getting pretty low. They're going to want to get that back up, you know, once this deal is signed. And when they do that, they're going to try to raise about, 600, 700 billion. They're going to probably issue debt, put it back in the account. Some of that's going to drain liquidity from the system. Some of that liquidity would be destined for stocks. So that's kind of a, something on the liability side. On the asset side, the rush into AI, ultimately, these themes, always end in tears because we take it too far. But these kind of themes, these technology shifts can go for longer and much higher than we think.
Can you elaborate on that?
Yeah, I mean, think back to the 90s. In the 90s, we've had four major themes, probably since the 80s, actually. You had, first the push into personal computers in the 80s and 90s. The internet and .com followed. Mobile, who can deny that the iPhone hasn't changed communication? This is probably the fourth next big thing. And I remember in the 90s, companies like AOL and Cisco, the bears were saying they were in a bubble. Ultimately, they were right, but the party lasted another 4 years. Companies are tripping over themselves to announce their AI initiative right now. So I think we're just getting started.
Well, this is the tricky one because I don't really want to confuse our audience, but already this morning we heard Bank of America's equity strategy team with comments saying there is a mini bubble forming within the AI stocks. They're advising investors to get away from that. I mean, what? And they use the sort of example of, I guess, well, you were alluding to it, 1999, at a certain point when the Fed sees the economic data still strong and feels the need to be aggressive with rates, that can change the story. That seems to be one of the other stories we're talking about here, and in Canada as well, because you have the Bank of Canada. They've been on the sidelines. Now, after the inflation data this week, there's this belief that they might have to raise rates come their next meeting in June. So if you're a believer in technology and AI themes, but the stock prices are elevated, how do you navigate that economic uncertainty as well?
Never underestimate investor greed. They will likely push this too far. The Fed is, of course, a big issue. I don't think the Fed has the tools to get this job done. This is going to have to be a marriage of monetary policy and fiscal policy. And in the end, that's how this is going to have to work out. I grant that, core inflation is elevated, but, I'm not quite sure where we got the 2% in the first place, but let's say we've got to get that back down. Congress is going to have to do their job as well. It's not just going to come from raising rates. If they keep raising rates, something else is going to break. We've already broken 3 or 4 banks. Something worse could happen out there, and they could be, self-defeating.
Yeah, well, I was citing a note from longtime economist Torsten Slok this morning, who talked about the non-recession recession, and his point was actually, like, let's say we're getting closer to the end of the rate hikes, whether we stay at these elevated levels or not, we'll find out. But let's say that because the economy has navigated relatively well so far, and the jobs market is still relatively strong, that you don't see sort of a huge deterioration in the economy per se, but that you potentially, because let's say these rates stay elevated, and that makes for a sort of a more complicated borrowing cost regime, that it's just not easy for some of these, despite the greed, as you mentioned, some of these stocks to stay at elevated levels. So his point was maybe you see a recession in assets, not necessarily a deep one in the economy. That's his view. I'm still feeling like you're not betting against equities right now.
I am not. I'm pretty invested at this point. It's been a struggle because I've underperformed this year. I was probably on the wrong side of where I should be. You know, most stocks are flat on the year. I mean, the equal weighted S&P 500 isn't up much at all, yet the S&P 500 is up a lot, largely because of the technology names you've mentioned. But there's going to be a productivity boost. It's not going to be just about the AI machines like the NVIDIAs and the rest of it. It's going to be how companies use this. Not understanding large language models is going to be like not understanding Microsoft Office 20 years ago. You're going to have to endorse this. You're going to have to use it in your workflow.
Yeah.